So just a few things to talk about cost of capital. You'll get practice on number 7. Some of y'all were emailing me on number 7. How does number 7 application compare to 8? Number 7, do exactly like the video shows. You don't need to go out and do your rolling beta or anything like that. Just whatever the video shows for number 7, that's what you got to do. 8's a completely separate operation. So we're talking about cost of capital. We're going to get into this more, what happens when you have debt, but there's actually a formula that says take the beta of the firm if they didn't have debt and bring in the debt, and that's going to raise their beta, and there's an actual formula of that. We're not using this formula. If you need it, you can look it up. You just type unlevered beta into Yahoo Finance or into Google, and the formula will come up. It's a pretty simple formula. You notice we made an adjustment for operating leverage, which is your fixed cost. There's no formula for that. No one's ever come up with a formula for that, which is just as important as debts. So I tend to do it more like what you do in number 7, which is, okay, if their debt's above average, I'm going to push their beta up without making it a precise calculation, which is all we're going to do in here. There's our cost of capital for equity. We use the levered beta. You're going to get some practices with this when you get into number 8. Number 8, we're going to be doing more and more, probably starting next week, some practice problems from the exam too, so you can get a little more practice. Most of them you're going to discover look exactly like the applications. The WAC problems are a little bit of a mix of 7 plus 8, so you'll just see. So I'll give you an exact, in fact, I think I told you before, but I'm going to give you the exact exam from last year so that you can work through it, and then I'll do a YouTube that solves it, so you'll see the format. There is something, you know, I've had professors that take great pride in how horribly students do on their exams. I don't understand that. It's almost like they take great pride in how poorly they taught the material. But one of the confusions is we change our jargon a little bit. So you might understand it with this jargon, but then you see it slightly different. And you want to get to the point where you can take the application, even if the jargon changes, you still understand it, can apply it. But at the same time, exams are stressful. So the fact that some students can't do that because it's a stress exam, I kind of understand that. So I want you to see exactly how the jargon I have on the exam is. So you're not surprised on the exam. You know exactly how I'm going to word it. So it will be very similar. Some of them, like application 2 and 3, will be exactly like on the exam. All right, there's not going to be any difference on those. But some of them will be slightly different. The bond valuation and stock valuation will be just like your applications, so probably 80% of it. So we'll do more and more practice as we get closer to the exam, so you're ready for that. There's a lot more math on the exam. You don't have to memorize massive amounts of formulas, but there are some formulas you just have to know. Every formula I require you to learn, you should just know as a business student, not as a finance major, but as a business major, you should just know them. So the present value interest factor annuity, I'm not making you memorize that formula. You type that into Excel so you see how that works. That's not a formula you memorize. You can look it up. But the cost of equity, beta, risk-free rate plus beta times market risk premium, you should just know that formula. The WAC formula, the weight of debt times the cost of debt times 1 minus the tax rate plus the weight of equity times the cost of equity. That one you should just know because you're a business major, all right? How do I know what you should know and shouldn't know? Well, I've been doing this for almost 40 years, so you kind of have to trust me. So just trust me. This is the stuff they assume you know. All right. There are certain things. I know there's students who want to graduate knowing as little as possible. You don't want to be that student. There's certain. Do y'all agree? There's certain stuff you should just know because you graduate from college, right? So you shouldn't have to look every single thing up. So trust me on the exam. If you have to memorize a formula, you should know it. All right. So we got our cost of capital. There's the formula. We worked up to it. Application 7 is going to get you some practice on that. We did the WAC examples. So what can we use WAC for? All right. So the weighted average cost of capital, first of all, it's the discount rate you use for cost benefit analysis. So if you go to UTSA or Valero or HEB, they will have a weighted average cost of capital, and that's what we're going to use if they're deciding whether to build a new warehouse or deciding whether to buy a new computer equipment or something like that. That's the cost of capital they use. One thing my first boss in finance, boy, he scared the life out of me, which is what you want. You want your first boss to scare the life out of you. This guy, he was a PhD in finance and economics. He edited, you'll see his name in finance books all the time. He edits them. But he says there's 2 ways to increase the value of a firm. He said the first way is increase free cash flows. We kind of talked about that in your problem number 1. You know, they do a good job of managing their working capital. They're growing fast. They get good revenue growth. They have good earnings growth, good margins, good turnover. That's all free cash flow. But the second thing is reduce the firm's risk, which means reduce the firm's, I don't know why the M is not typing. Yeah, I'm typing the M. Someone switched the keys, I think. That's the M key. There's the N key. So those are 2 ways. And he says it's pretty simple. You either get more cash, you just grow. This is really all about growth. You grow the firm or you reduce its risk. Our risk management class, we talked quite a bit about this because there's one thing I know firms do that destroy value, and it has to do with the second one. They take on all this risk and they don't get compensated for it, and it just destroys the value of the firm. So we spent quite a bit of time. In fact, I had to write a big essay question on the first exam about that. And so we're going to talk about this. How do you get the firm's cost of capital lower? And you find some way to reduce risk. So we'll get into that. But he says most people think about the first one, they forget about the second one. And you really can dramatically increase the value of a firm. If the firm's doing something that's really risky and it's not all that valuable, just stop doing it. And the firm value will shoot up. Sell off a subsidiary, that's just, you know, high risk, whatever. So how do we actually do this in finance? And that gets in this next thing, economic value added. It's probably one of the easiest problems of the applications. Now, Bloomberg does have a function. So if any of y'all have a Bloomberg account, you can enter your company, type the F8 function and type WACC, and Bloomberg will show you the entire cost of capital function for your company. Some of y'all might need this for your capstone class. We did it today, Dante, from Larissa's class before yours. She was calculating her cost of equity capital, and she got 5.2%. So I said, well, let's go see what Bloomberg says, and Bloomberg had 5.2%, entirely just pure coincidence. But they gave her great confidence. Oh, right, I got the right answer. Well, I don't know, it's just completely different inputs, but we just happen to get the exact same answer. So you can use that function. It's an interesting function. I don't like some of their inputs. They're kind of bizarre, but they show you every single thing. If you want to know what their weight of debt is, they'll show you how they got that. If you want to know their cost of debt, their tax rate, their weight of equity, they show you all the inputs. It's all right there. If you don't like one of their inputs, you can type over your own and they'll readjust the number for you. So it's a pretty cool little function. But think of WACC as your required return. So what is WACC? WACC is cost of capital, weighted average cost of capital, the required return for the firm. It's also known, have you ever heard this term? Has anyone heard hurdle rate? Is that completely new to you? What's a hurdle rate? Y'all know what a hurdle is, right? In high school track, my coach had me run hurdles until he discovered my body doesn't bend. I was like a piece of plywood trying to run hurdles. I was really, really bad at it. But a hurdle rate, why you get it, you got to jump over something. So the hurdle rate is, hey, if the project doesn't meet that hurdle rate, don't do it. If it's not high enough to get over the hurdle, don't do it. So we have a lot of terms for this cost of capital. If you just hear cost of capital, it probably is the weighted average cost of capital. Because if they mean the cost of equity capital, they'll usually say the cost of equity capital, right? So cost of capital probably is the weighted average cost of capital. It's also required rate of return. What do we mean required? That's required to compensate risk. How much return we need to get us what we need to cover us for risk. And it's from the concept of the stockholders. It really is stockholder focused. And the hurdle rate means that's the minimum we've got to get. Hurdle rate and required return to me, they're the exact same thing. There's just different ways of saying it. There's probably 6 other terms out there that I can't think of right now, but we have a lot of terms for the same thing. So that's what you need to return. Return on invested capital. I should have written this out. Return on invested ROIC. That's the return you actually got. WACC is what you need to get. Return on invested capital is what you actually got. Which do you want to be higher? Would you rather have a 7% WACC and a 2% ROIC, or a 7% ROIC and a 2% WACC? Which would be better? Higher ROIC. Okay. So return on invested capital. What does invested capital mean? When you see that term, it means both debt and equity. It's all of your capital providers. Remember on paper 1, you did return on equity. What capital provider is that? That's only the stockholders, right? It doesn't include debt. So return on equity is just the stockholders. Return on invested capital is a return for both the stock and the bondholders together. And why do you need them together? Well, because WACC is both stock and debt. Remember, it was cost of debt, cost of equity. So return on invested capital is your total return on all the capital the debt holders and stockholders have provided you. You compare that to what their cost of capital is. The difference in those is called economic value added, EVA. And a lot of people consider that to be the best measure of how management is doing. When I was at USAA, when Bob Davis came along, he introduced EVA to USAA. I think they got rid of it after he left, but for several years while he was there, we were an EVA firm. I forget when EVA was created. Oh man, that's not a name I was expecting. These may not be. Let me type economic. It's really hard to switch those 2 letters. Econ, especially when they're both in the same. There we go. Stern Stewart. I was trying to think of his name. Stern Stewart. So if you hear the name Stern Stewart, that's economic value added. During the 1990s. So they came up with this concept, and it just took over like wildfire. A lot of people interpreted it. There were studies where they would ask investors, what's the most important thing you look at? And they would say EVA, that's the most important thing. So it became this really central thing to finance. I can't remember when Bob Davis joined USAA, but it was probably in the 90s, I would think. I'm pretty sure because, I remember presenting to him on the .com crash. So he started using this pretty quickly. I don't know what paper he read to figure that out, but a lot of firms do use it. A lot of investors use it. So essentially we're seeing, is management getting the return equal to or greater than the return they need to get at a minimum? If they are, they're adding value. If they're not, they're killing value. All right, sounds like a pretty good term. If I were running a small business, I would be an EVA person. That's the way I would look at my business. All right, so it should be the best way to ask, is management doing a good job? So at USAA, we had an EVA spread goal of 1%. We wanted our return on capital to be 1% higher than our cost of capital. Where did that 1% come from? It was pulled out of thin air from somewhere. I don't know where. Bob Davis never explained to us where he got it from. Theoretically, zero is good. You need a 7% return, you made 7%. Your investors should be happy. You gave them exactly what they needed, but it'd be nice to add more than that. You can go back and look at EVAs for firms. And I mean, to me, the best example, I might be able to show you this next week. I'll go down to Bloomberg and get it. There were several years ago where Home Depot was really struggling. And so I was kind of touting their stock as a turnaround story. If you looked at the EVA for Home Depot, it went from negative to dramatically positive. And if you look at their stock price materially outperformed Lowe's. And if you were to look at any one thing that would predict a stock price better than anything else, it's EVA. When you see EVA goes up, stock prices go up. The problem is predicting what EVA is going to do. But if I told you which companies are going to have the best EVAs going forward, that would be the best stocks to invest in. All right, I can't tell you what those companies are. I can tell you who historically has done a good job. But EVA spread really does define which companies do best in the stock market. And that gets you down to that maximizing shareholder value. That's what you're trying to do, is get as much return as you can. Because, I mean, WACC is stock and bondholders. But once the bondholders get their coupons, they're done. Everything else you get goes to the stockholders. So once you cover your cost of debt, everything else goes to the stockholders. So it all goes to the stockholders. Who's famous for maximizing shareholder value? I remember that. Have y'all heard of, his name starts with an M. Milton Friedman, Uncle Milton, y'all know him? He has some of the best YouTubes. He's passed away, unfortunately. I saw him in one conference. I was like scared to breathe. I mean, he really was quite the famous person. You should watch some of his YouTube. He has people screaming at him, and he never gets rough. Very logical. He would just they're like gonna rush the stage to attack him, and he just answers them very logically. He has some great books you should read. Very much on the libertarian side. Very interesting guy, smart guy. He's in the Chicago School of Classical. He's a very monetarist kind of person. Interesting guy. I would read his books. What I love about his books, first, very logical. The other thing I like is when he disagrees with someone, he doesn't show them disrespect. He's quite respectful for people he disagrees with. Like, you can't say that about Krugman and some of the other economists out there. So I like him. He's a good person to read. Even if you disagree with everything he says, you should read him. In fact, it's even more reason to read him. So, so yeah, Milton Friedman. He's the one that came up with maximize shareholder value. He gets a lot of bad press today on that. People are always bad-mouthing him. They're bad-mouthing him today because he's passed away, and he always crushes people in debates. So they have no trouble doing it today because he's not around. But he didn't say what they say he said. So you should go back and read exactly what he said. He didn't say, rip off your employees, rip off your customers, rip off your vendor. He didn't say that. He just said you should focus on shareholder value. And in doing that, you're going to have to treat your employees extremely well, or you're going to have to treat your customers extremely well. So don't trust everything. You're probably going to have a professor that hates Milton Friedman. That's fine. Set up a debate with them and me. Don't you wish you could have them debate Milton Friedman? That would be even better, wouldn't it? I assure you they would lose that debate. All right, so there are other stakeholders out there. Employers, employees, customers, suppliers, bondholders. Should you ignore them? And Dr. Demodarian, he also talks about this. He says, no, you can't ignore them. If your employees are upset, they're all going to leave the company. If your customers are upset, obviously that's not going to work for a business. I think Demodarian was at a conference where the person before he spoke said, the most important thing a firm should do, their really only goal is to make customers happy. And Demodarian got up and said, that's a piece of cake. Just give everything away for free. Your customers will be really happy. Is that a good business model, do you think? So Demodarian says, if your number one goal is to make stockholders happy, you will make everybody else happy. I had to do my first presentation at USAA, Boy, I didn't know what I was doing. It's kind of scary. I was like 6 months out of college. I was presenting to the board. Uh, my boss wanted me to prove that it's okay to be profitable and be a good company. And what I discovered was the firms with the highest return on equity also had the happiest employees, the happiest customers, the happiest suppliers. So we'll see. What do y'all think of Amazon? They just have a unionized, or Amazon employees happy? That one's kind of on the edge, right? But for general cases, you'll see studies. Usually the more profitable firms have happier employees. Maybe it's because their stock options are doing really well, who knows? But that's something you just always look at. It's not 100%. I think Amazon right now is a big debate, but you can certainly have that debate. But have the debate. Don't just buy everything your professors say. Go out there and read it yourself. Read Krugman, read Milton, read all of them, and decide for yourself. But you're taking a finance class, so we're going to stick with Uncle Milton. Focus on the stockholders, and everybody else will work out, because you've got to make them all happy. You have no choice. The problem is when you get return on invested capital, what the accountants give us with GAAP accounting, there's a lot of compromises and workarounds with GAAP accounting. That doesn't really show the true return that the firm is doing. So what we're going to do economic value added, you notice the word economic is in there. Economic value added as opposed to accounting measures. So there's economic measures and there's accounting measures. How do you get from an accounting view of the world to an economic view of the world? So that's what we're going to try to do. That's what EVA is all about. What EVA is trying to do is try to figure out the true return of the firm and compare that to their cost of capital, and then we'll be there. There's formulas out there that we're not going to cover in this class, so you don't need to worry about them. If you're a finance major, I highly recommend you take Dr. Katapakham's class. He's an expert. He's done a lot of research in this area, so I really try to take his class. He'll go on this in quite a bit of detail. You probably take it as your next class, right? Don't y'all take corporate finance next? He's probably one of your choices. So I don't know who the other professors are. They're probably just as great, but I know Katapakham's very good. And he'll go into more detail on this, all right? So we're not going to quite get into it here. So we're going to simplify it just so you get introduced to the concept. And I'm going to give you a very easy example. Then we're going to do a more complicated example. The more complicated example looks just like your application number 9. All right. And then you'll have the YouTube, so you can do number 9 as well. All right. So let's assume you quit your job and you're going to start your own business. I hope a lot of y'all will do that. You quit your job. You have $100,000 saved up. You're going to put it into your own business. Your first year, you make $62,000 in revenue. Your expenses are $61,500. You made $500. Now you might say, $500, I can't live off of that. Well, maybe $61,500 of expenses included you paying yourself a salary. All right, so maybe you could live off of that. So the question is, did you do a good job? The accountants will say, you did great, you had a profit. Finance says profit's not good enough. It's got to be more than that. Why? I struck this out because I typed this in our previous class and meant to delete it, but it still belongs. Why don't we think this is the right answer? Because there's an opportunity cost. You could have done something else with that $100,000. You could have kept your job and put that $100,000 somewhere else, right? So you have an accounting profit, but do you have an economic profit? And so what EVA is going to do is say, let's take that accounting profit and let's adjust it. Adjust it for what? Well, are there things in accounting that really we know are not economic? And there's one really obvious one. Do y'all remember this one? Depreciation. What's depreciation? What does your accounting classes say? So let's say buy a building, spend $100 million on it. Useful life is 50 years. What's your depreciation going to be? What y'all learn in accounting? I hear y'all whispering it, but straight line is what most firms do, right? For their accounting, for GAAP, for taxes, they do what? Maker's table, remember, modified accelerated depreciation. They use that. Why? Because they can depreciate it faster and get tax deductions. But most firms use straight line for GAAP. So what does that mean it's going to be? Someone tell me the formula. 100 million divided by 50. So what are they going to do? What's that $20 million or $2 million? They're going to do what? They're going to expense $2 million every year for 50 years, right? Now, I was at USAA early on. You know, I learned a lot early on. I went to some meetings where the departments were fighting with each other. You start learning about a company when you're in, you know, you're this newbie and you're like, wow, these people hate each other. They were fighting. But USA was struggling because their expenses were way too high. And so the CFO of USA, the controller, came in and said, I know what we can do. Let's change the useful life from 50 years to 80 years. So what happened to our depreciation? It dropped from $2 million to $1,250,000. We saved $750,000. How much more valuable or profitable was USAA? Anybody think the CFO improved USAA's financials? Or do you think that's smoke and mirrors? Completely fake, isn't it? You know a firm's in trouble where they're trying to improve their numbers by increasing the life of an asset. So why did USA? They had to go through a major restructuring because their expenses were, they had to finally just say, hey, we got a problem. You know, they could have depreciated for 200 years, right? That building will probably still be here 200 years from now, right? That would save you a lot of money. So what do the accountants say? They say it is a kind of random allocation of costs over time. Random allocation. They even admit it's not economic. Right? So depreciation, the most obvious one. I think almost every firm out there that does economic value added, they add back depreciation. That's kind of the obvious one. USAA adds back depreciation. So $600, you had a room in your house and you use it only for this business, so you decided to appreciate that room. And that was $600. So you had an expense of $600. All right, that's fine. We'll add that back. So we had $62,000 in revenue, $61,500 in expenses. Our accounting profit was $500, but we're going to add back the depreciation expense. That means our economic profit was $1,100. That is the only adjustment you're going to make in this class. What other adjustments would you make? Well, if any of y'all go work for USAA, go look at their EVA spreadsheet. I sure hope they still have it. They may have gotten rid of it with Robles and Stewart and Wayne. Wayne might have brought it back, who knows? But it was a massive spreadsheet. They had hundreds and hundreds and hundreds of adjustments. It was pretty complex. So it'd be pretty fun to just sit down and say, what else are you adding back and adjusting for, right? It's a pretty complex, but depreciation is the only one you have to handle. I do throw in a kind of a fake one. I also tell you that 60,000 of that is the salary this business person paid themselves. Would you add that back as non-economic? Well, to me, that's an economic cost, right? Because she started this business, but she could have been working somewhere for 60,000. So paying herself 60,000, her time is a value, isn't it? Paying herself 60,000 for her time, that's valuable. So that makes sense to me that would be an economic cost that she should include. All right. Now, there is another cost that the accountants ignore, and that's cost of capital, especially the equity cost of capital. So you'll see that more in the second example. And that's where the real opportunity cost comes in. Because what else could she have done with $600,000? Well, she could have gone out, instead of quitting her job, she could have kept working her job, and she could have put that $100,000 into a one-year treasury bill. And if she'd done that, she could have made 1.2% or $1,200. So now how did she do? She had $1,100 in economic profit, but she could have just bought this treasury and made $1,200. She would have been better off, right? Had just stayed with her job, put the $100,000 in the treasury, she would have made $1,200. But there's a serious problem with that. What's more risky, buying a one-year treasury or starting your own business? Your own business, right? So you're not even, the $1,200 is better, but not only that, but it's really low risk. She knew for sure she could make $1,200 if she invested in the treasury. Starting her own business, who knows what she could have done. So she'd been much, much better off with the treasury because it was low risk. But there's another problem. So what if she invested in the stock market? The stock market was up 28%. She could put $100,000 in the stock market and she could have made $28,000. Instead, she quit her job, started her own business. She only made $1,100. Pretty bad decision, right? Now, is it hopeless for her? Well, part of it, you might say, well, it's her first year, so her first year she can't expect making a lot of money. So you'd have to kind of look out into the future, right? You have to say, well, okay, maybe 1 or 2 or 3 years, we're not going to make much value, but then eventually we will. Some of you are handling that with your franchise, right? The first year, you may only get half your revenue, and you're probably going to lose money the first year, and then you get up and running and you go. So yeah, maybe that's okay for first year. But what if she's only going to make $1,100 the next 50 years? Would you recommend she start this business? Now, she'd probably be better off staying where she is, investing that in the bond market or stock market. She can make more money. She'd be better off, all right? So that's what we're looking at here. So let's go through the longer problem, which looks a lot more like your application 9. And this is how, if I were running my own business, if I were doing one of the franchises, I think we've got, what, Wingstop? What else did we get? I can't remember the other ones. Planet Fitness. If I were doing those, this is the exact type of analysis. I found one of my graduate students. He was doing a healthy vending machine business. Vending machines could have been your cost benefit analysis. You could certainly have done that. Interesting business. One of my students in my other class at 9 o'clock, when he was in high school, he started doing vending machines. And he was making a lot of money doing vending machines. So I asked him, how much money you're making? He went through it. And so we actually did an economic value added analysis of his vending machine business. And it was quite profitable. He was doing really well. His one problem was scaling. It was a very profitable business, but he needed it to grow much faster. He needed to get a lot more customers. But the vending machines that he had were making him a lot of money. It was a good business, really, really great business. But do we have healthy vending machines at UTSA? I didn't notice too much. USA had them. USA had this thing where if it was low fat, they charge you 50 cents. If it wasn't low fat, they charge you 90 cents for this thing. And they're trying to get us to eat healthy. And I think most people are buying the more expensive one just because it's like Big Brother was watching them. They're like, I'll show you. I'm going to eat the unhealthy stuff. All right. So yeah, if I were running a business, this is exactly the way I would look at it. All right. So let's look at this. You invest $40,000 in your business. That's your money. So is that equity or is that debt? This is your business, your money. Debt or equity? That's equity, right? You're the owner. Debt means you're not the owner, you're just loaning someone money, all right? So that's your equity. You think starting your business is maybe as risky as investing in a stock market where you'd expect to make 8%. Since you're saying, I can start this business for 40,000 bucks, or I can put $40,000 in the stock market. I think those are about the same risk. Obviously, starting your own business is probably a lot more risky than investing in the stock market, but you think they're about the same. And it's your money, right? So you can decide whatever you want. So this is a fairly subjective number. What do you think you need to make? What's your hurdle rate? But you say 8%. You're saying, I'm going to start my own business. If I can make 8%, I'm happy. That covers my risk. Maybe you use the capital asset pricing model, but you remember what I said about HEB. If this is your business and your money, the capital asset pricing model doesn't apply because it's not a well-diversified business. You remember that? So it probably doesn't apply, but we're going to go ahead and do it anyway. You borrow $40,000 from the bank. So is that debt or equity? That's going to be debt. And for some reason, the bank's only charging you 5%. They don't think you're all that risky, so that's good. Somehow you convince them. Do you have any collateral? You don't know what collateral is? Right? Maybe you're going to buy a building or buy some equipment. So if you go insolvent, the bank gets all of that. What does that do to your interest rate? Pretty dramatic, right? I remember when I was on the credit union board, if you borrowed money for a house, we charge you 5%. If you just borrowed money with no collateral, we'll charge you 18%. Big difference, right? Your credit card, how much collateral does your credit card have? 0, right? How much higher is your credit card rate than your auto loan rate and your home mortgage rate, right? So collateral makes a big difference. So maybe one of the banks charging you so little. So your capital employed, have you ever heard that term before? You can employ employees and you can employ capital. You're simply just putting it into action. So you got $80,000 of capital, all right? 40,000 of it's yours, 40,000 of it is the bank. And here's your first year. You make 70,000. Your expenses are 65,000, maybe 60,000 of that is a salary you pay yourself. You also have $440 in depreciation. You're going to pay the bank 5%. For 40,000 bucks, you're going to pay the bank $2,000 in interest. So your accounting profit is $3,000. So here's how we're going to get from the accounting profit to economic profit. There's 2 adjustments we're going to make. The first one is the depreciation. Why? Because we say that's not economic. We're going to add that back. The second one is the interest expense. Why? Because economic profit is your profit before you pay your capital providers. And this is where we think accounting is wrong. Accounting only includes the cost of debt. Accounting does not include the cost of equity. But what we want to do is we want to look at the return the firm produces before we pay our capital providers. So we're going to add that interest expense back. Okay? So our economic profit is $5,440. That's how much we made before we pay our capital providers. Now we're going to look at our cost of capital. There's that $2,000 back, right? We essentially said, let's take it out of the accounting and let's move it down to our cost of capital. And then our cost of equity. How do we get that? Well, we're employing $40,000 of our money, and we think 8% is the right number. You see how that 8% is the most subjective number of all. This is where I think you're going to find with your firms. When you get a job, you're going to find the cost of equity is the most Mickey Mouse number there is out there. I don't know why Mickey Mouse or whatever. So it's the silliest number out there. Why? Because a lot of management spend very little time working on. Remember I said at USAA, Bob Davis said 5-year treasury plus 5%. Like, yeah, like kind of like that. Valero was like that. I'll just do what we did last year. I talked about Citibank. Let's just use 10%. Why? Well, we've been doing that for 40 years. I don't like that at all. One of the most important numbers there is in your entire firm, and firms like, just use 8%. So we probably should spend more time on that, but I'm giving you that number, all right? So 8% times 40,000, we need to make 3,200. So we need to make $5,200 to pay our bank and to pay ourselves. How much did we actually make? We made $5,440. Did we do a good job or a bad job? Anything greater than 0 is good. We're adding value to the firm. That is your economic value added. Sometimes we use the word EVA spread. By spread, what we mean is convert this into a percentage. All right, so our economic profit, our return on capital, is the economic profit we made, $54.40, divided by our capital that we employed. So we had a 6.8% return on invested capital. Our cost of capital was the 5,200 divided by our cost of capital, 6.5. It's essentially the weighted debt times the cost of debt. Our weighted debt here is 50%. You'll see that 40,000 over 80,000. So 50% times 5% plus 50% times 8%, that gives you 6.5%. So our EVA spread is 6.8% minus 6.5%, or we had an EVA spread of 0.3%. Anything greater than 0 is good. So if you go, and I think I'll do this for next week. I don't have access. I wish I had access to Bloomberg here, but I'll show you the Bloomberg screen on Home Depot and show you its stock price. And you'll see their EVA negative, 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 and then go up. They really reinvented Home Depot. I never noticed because I can't tell when I'm in a Home Depot or Lowe's. Sometimes I'm in one and I have to go out and look because I can't remember which store I'm in. I can't tell them apart, but I don't do much home improvement kind of stuff. But anyway, if you look at the stock price and you look at the EVA, Home Depot definitely turned itself around and Lowe's has kind of stayed where it was. And you'll definitely see it in the EVA, you'll see it in their returns, their stock returns. All right. How many of your firms use EVA? I have no idea, but you should ask. When you get there, for interns, I mean, you know, interns, I don't have any, y'all have interns this summer? Who's got an intern this summer? Are they pretty good ones? Yeah, USA's a cost. So, okay, Jazz, you're gonna go find all this stuff out. So go find Laura Bishop and ask about the WAC, ask about the EVA. Do y'all still do EVA? All these kind of questions. And if they give you a bad time, just use my name and you'll be fine. I mean, it's an incredible opportunity, right? As an intern, you need to be learning as much as you can, and they don't have enough for you to do anyways. So just walk around the company and learn stuff. I mean, that's an incredible opportunity. So yeah, see what your firm is doing. If you're working for Valero, I mean, you're cybersecurity, but still ask, right? Go over to the finance department. You know, it's impressive. You want to learn the business. You want to know everything about the business. So take advantage of this. If they don't use EVA, you might ask them why. Not in an accusative way. Why do you use it? You know, I'm curious. You know, do it in a way that is non-accusatory. So what is about EVA you don't like here? You know, that kind of thing. Or how do you get your cost of capital? Do you use the capital asset pricing model for your cost of equity? You know, those kind of things, and just see. All right. And then Jazz asked, if they do still have it, ask to see the spreadsheet. I forget the guy, his name was Dustin, huh? All right, I'll try to remember on email you, email me, but yeah, unfortunately, all my contacts at USA are retiring, so I'm losing, but I still know enough. The nice thing about USA is that a lot of former UTSA alums working there, so there's still a very strong connection there. HEB, you know, a private versus public firm. USA's private, HEB's private. They still do this kind of stuff. Just because they're a private firm doesn't mean they throw out all of finance. So go still ask them these questions. So don't waste your intern not asking questions and finding this stuff out. All right, so hey, I put this here again. So the way you increase the value of the firm is increase free cash flow or reduce the cost of capital. So that's where we're going to go next. But any question on economic value added, you'll be able to find a lot of articles Investopedia, how can a firm improve? Let's see if they know what they're talking about. So here's the formula you'll get in Dr. Catapacum's class. Increase revenue, decrease cost of capital. That's what we're going to talk about there. So hire a consultant. That's not the best answer. So the question is, how do we improve the value of the firm by reducing the cost of capital? Now we saw with the cost of equity capital that beta was a big part of that. How do you reduce your beta? You reduce your beta by making the firm less cyclical, making the firm less fixed costs, those kind of things that reduce beta. But here's the question we're going to get into next, and you're going to see it when we get down here. We're going to have some introduction to it. But so if you want to read ahead, you can actually type this into Google, and you'll see some of the charts that we're going to use. You just say optimal capital structure. And when you do images, you're going to see some of the images that we have. On the exam, I'm going to give you one of these images, and you're going to have to label it and explain it. And there's two types, you'll see. There's one type where the lines go up, and there's one type where the line goes down. And you'll have to be able to figure out which one's which. So that's where we're headed. Is there some optimal way that we can use debt and equity so that the value of the firm goes up? All right, very, very famous theory in finance. So that's where we're headed. Before we do that, we're going to do a little bit of introductory kind of stuff because there's a little jargon we need. But that's where we're going. All right, so first of all, why does the firm need capital? Why don't we just have the firm with just $1 of net worth, no debt, you just run the firm, your return on equity is like 87 trillion%, right? Why don't you just have $1 and just have barely enough money? And well, because a firm needs cash flow, right? We talk about working capital requirement. You got to buy inventory, you have receivables, those kind of things. The firm needs to buy assets. They need to buy buildings and machinery. So you need capital. All right, this is my big debate with accountants. Accountants think of the word capital and they think of assets. They think of capital assets, but capital is not an asset. A capital is liability and net worth. Capital is the money you get from outside to buy capital assets. All right, so always make that distinction. Capital is something on the right-hand side of the balance sheet. It's debt and it's equity, and you buy capital assets. So a firm may need to buy new servers, buy new buildings, buy new trucks, research and development, inventories, those type of things. So those are funding needs, and you need them from outside. It'd be nice if the firm produces so much cash flow they can do everything internally. And some firms are at that point where they're just so cash rich they can do that much. Most firms still have outside capital requirements. So external funding needs are your funding needs minus what you can do internally. I'm going to skip some of that. Y'all can read through the notes. So how do you get those external funds? Let's see how much of the world y'all know here. Do y'all know what the term capital markets means? So we just said capital is what? Debt and equity. So capital markets are what? It's where debt and equity trades, right? Stock markets, bond markets. So capital markets, are y'all capital market users? So if you are a finance major, hello, what is it? Oh, I accidentally hit the M. So Ameritrade, have y'all heard of Ameritrade? So if you're a finance major and you've never traded a stock, you better hurry up and do it. If you've never actually gone out there and traded a stock, you can trade a stock even if you have no money. That's kind of the wonderful thing of it. So I would strongly recommend, if you're a finance major, I'd recommend even if you're not a finance major, they go out and get an account. Ameritrade is a perfectly good firm to use. I use Schwab. I love Schwab. I don't know if Schwab does it what Ameritrade does. What I love about Ameritrade is they let you set up paper portfolios. So you can go in and just pretend, and, put $10 million in there, pretend money, and you can start trading. You need to do that. In an interview, a paper portfolio is just as good as a real life one, because I know you're a college student. They know you probably don't have millions of dollars yet, so they know, but you can pretend. And so Thinkorswim will let you set up an account. I don't have one with them, but you can set up an account. They'll let you do a pretend account. Usually, and this is why I don't recommend Schwab. As much as I love Schwab, I'm not sure Schwab will let you set up a pretend account. So a lot of brokers, when you set up an account, they want you to fund it with some money. They're going to ask you, where are you going to fund this from? And you're like, I don't have any money, but I want to pretend like I have $10 million. They have to set that up so you can actually do that. The Bloomberg machine has a pretend trading site as well. But just go in and try it. And Thinkorswim does just about everything. You can do stocks, you can do bonds, you can do futures, you can do foreign exchange, options. You can do everything. You can short stocks, you can buy on margin. Try it all. Lose a lot of money. It's really fun to lose paper money, a lot more fun than lose paper money than real money. And just get some experience. You do not want to sit in your first finance interview and you have to admit you've never traded a stock in your life. Now, I know some PhD finance professors who've been teaching for 30 years who have never traded a stock. And they just have never had a reason to. They're teaching stuff that they don't really care to do in practice. So that seems strange to me. I've had some of them talk to me like just really basic questions of stuff I just thought every finance person knew. But when you're in academia, it's a very different world than when you're actually out there trading. So get out there and do it. Get some practice. Just do an individual account. Boy, they're asking you all kinds of questions here. Open an individual account. So you have to give them tax information, all that. So I haven't gone far enough to know when you tell them, hey, I don't have any money, but I don't pretend like I do. But at some point, hopefully that will work out. But get yourself an account. If you know, Robinhood might allow you to play money. I don't know if you all know if Robinhood allow you to do that. I don't know if Schwab does, but you know, find something out there. Or if you can't, call up your uncle and say, hey, I need to get some practice. Can you just give me $100,000 to play with? And just see what you can do with it. You know, he's worth what, 20 million, so he can do that for you. All right, so capital market, it's anything that's traded. All right, so real estate is not on the capital market. That's what we call the over-the-counter market. It's a buyer, a seller. But a capital market is when a bunch of buyers, a bunch of sellers, they all trade on some kind of exchange, okay? So it's stocks, it's bonds, it's derivatives like futures and options, it's foreign exchange, it's all kinds of things. It doesn't include swaps, it doesn't include forwards because those are over the counter, but it does include futures and options. Get out there and try it. You know, options are scary things, but they're powerful things. I'm a big believer in options. Come up with a strategy and just try it. Put an iron condor out there, or do a straddle, do a strangle, do something strange out there, and just see what it looks like. Try it out. Lose a lot of money and just experiment. So capital markets, what they're trying to do is take deficit units and line them up with savers. So you got a bunch of people with extra money. You got a lot of people that need money. The capital markets put them together, and all this trading is going on. And the financial services industry provides all of this. These are your financial intermediaries. You have banks. Banks put borrowers and lenders together, which is kind of cool, right? Because you want to buy a car, you really don't have to walk around the neighborhood saying, hey, anybody want to loan me $20,000? That'd be kind of painful, right? So you go next door and say, I want to buy a $20,000 car. I need to borrow $20,000. Your neighbor says, well, I got $15,000 I can loan you. So, okay, well, let me go find somebody else. The next person says, well, I got $10,000. So, okay, well, I'll borrow 10 from them. No, that's be a pain, right? You just go to Frost Bank and say, hey, I need to borrow $20,000. Frost Bank finds all the savers, brings it together. What is a bank? There could be money center banks, regional banks, investment banks that don't really kind of exist anymore, community banks, credit unions, savings banks, all these different types of entities. Insurance companies, they're in capital markets. Life insurance companies, property and casualty, health insurance, they provide a tremendous amount of money. Life insurance companies, are the major lenders to corporations. They do a lot of lending for corporate bonds. Property and casualty companies, they lend a lot of money to municipalities. So they loan a lot of money to states and cities and hospital districts. So they're big lenders. They tend to lend more than they in the stock market. Investment companies, those are mutual funds. Y'all know what a mutual fund is? So if you want to buy 1,000 shares of stock, but you don't have enough money, then you can invest $3,000 and you join with a bunch of other investors, and you immediately get a big portfolio, well diversified, even though you don't have a lot of money. So firms like, well, who's the biggest one of all? The giant of all giants, $11 trillion now, aren't they? I don't know who that is. Getting close. Vanguard's second. I think they switched to M&M because I accidentally hit that. They say 10 trillion. It probably was 11 trillion back in February, but this has been a terrible 2 months for BlackRock. So BlackRock, $10 trillion. That's pretty amazing. I work for this puny company. It was 100 billion. I have students at press, I was responsible for 35 billion. I said, wow, that's a lot of money. It's like, no, they probably trade 35 billion in an hour. So yeah, these are some big firms. Vanguard, I think it's the second largest. $7.2 trillion. Fidelity, probably, I can't spell Fidelity. 4.2, they're up there, but yeah. So these are massive firms. They have mutual funds. They do a lot of other stuff as well. BlackRock's really strange now because they're now starting getting into residential real estate, which I think is really bizarre. But they're huge. Investment companies are strange because unlike banks and insurance companies, investment companies don't actually provide capital to needers. So we're going to talk about that. If you need money, you want to issue stock to get money, you do what's called an initial public offering. You go out, you get money, the investment banks set all that up for you, you get money. Once you get your money, the capital markets are going to be trading your stocks back and forth. But if I buy some Google stock and someone sells me Google stock, how much money does Google get from that? They don't get anything, do they? I'm just trading stock with somebody else. So mutual funds aren't really providing capital to corporations. They're just providing capital between savers and investors. So they're kind of an interesting entities. Exchanges, New York Stock Exchange, the NASDAQ, the London Stock Exchange. Those are the places that set up all this trading and exchanging going up. They're good in places to invest. You can actually invest in these companies if you like. And in government entities, they obviously, they borrow a lot out there. So, and they provide a lot of the regulation. Traditional view of this was that governments and consumers have excess money, and corporations in emerging countries, they need money. That's all switched around. We're all over the place now. Governments need money. Consumers were big debtors. Now they have a lot of extra money. It's all over the place. It used to be emerging countries were the ones borrowing money. Now it's the emerging countries that have all the money, like China, and it's the rest of us that are borrowing from them. And it's just, it's a really mixed up bag right now. So yeah, who needs cash? Who has cash? Who knows right now? So those providing funds, they can actually lend money to corporations and do it directly. They can actually buy the initial stock of a company and provide the cash to the firm directly, or they can do it indirectly. They can do it on the exchanges, and they buy the stock from somebody else that has the stock. A lot of smaller companies actually borrow money directly from banks. In fact, that's the big difference between the US and Europe. In the US, we have a massive corporate bond market where a lot of the money that corporations borrow is on the exchanges, is in the capital markets. But in Europe, corporations tend to borrow more from banks than they do in the capital markets. So very, very different world. So where are these markets? The primary market, that's the market where corporations get their cash. That's where they issue bonds, they issue stock, and they actually get cash that comes into the corporation. That's the primary market. Where do you trade? You trade where? The secondary market. All right. The secondary market does not provide any money to corporations. It's the primary market. And the first time they go out there and get money from the primary market, that's their initial public offering. You hear about those IPOs, that world is changing quite dramatically, right? Have y'all heard these terms? Direct issue versus, well, IPO versus direct listing. I'll try that as well. Who was the famous one that did that? I always forget. Was it Spotify? I think it was Spotify that did that first. We'll see. I get them all mixed up. It doesn't really say it here. It starts with an S, but I get them mixed up. So Spotify did a direct listing in 2018. What does that mean? Well, they said, you know, forget the investment bankers, forget all these exchanges. We're just going to go direct to the people who believe in us. So you might read about that. The world is definitely changing. Have you ever heard of SPACs? Special purpose acquisition companies. Does that sound familiar? SPACs. So direct listing and SPAC are two terms I never covered in my entire career. When I retired in 2009, they didn't exist. So the world is changing pretty dramatically. SPACs have been in the news pretty heavily. So you got some new terms you're going to have to learn. All right. I don't cover them in my classes because I didn't have to deal with them in practice. So I need to learn these things as well. They're interesting things. Who's a famous person who does SPAC? Didn't Donald Trump do a SPAC? And how is his SPAC doing? Kind of crashing, right? So SPACs are out there. Even former presidents are doing SPACs. I don't think Jimmy Carter's doing any SPACs, but all right. So this world is changing pretty dramatically. People are finding ways to get around the high expenses of the investment bankers and just go direct to the market. A seasoned issued is a firm who's issued stock before, but now they're issuing new stock. So it's not their initial public offering, but they are issuing stock to get cash into the company. So you're going to spend your time in the secondary market. Now, if you do want to go into the primary market, you can do that. What if you wanted to loan the US government money? You could go to the secondary market and buy treasuries, but if you go to the secondary market and buy treasuries, you're not loaning any money to the US government, you're buying somebody else's treasuries. But if you wanted to, you go to Treasury Direct. I think it's .gov, but I'm not real sure. Yeah, Treasury Direct. I've done this once. I loaned US government $5,000. I just want to see how the process works. If you're a finance major, you want to do this. It's an auction market. You can go in there, you can actually bid. You won't affect the rate. You'll just get the average rate that comes out on the other end. But you can actually go directly to the federal government. If the federal government's borrowing money, you can directly loan them money and you will have a treasury security and they'll send you coupons every 6 months. So it works. A lot of people have been asking about savings bonds. I don't know if you can do that from this site, but there's some hiccup in the saving bonds where you're going to get a really, really good return right now because of a quirk in the system. I've had people emailing me that, but you can only do $10,000, and I'm like, it's just not worth the time. But if you know someone that needs to get $10,000 invested, they might do that because of the way there's a glitch in the way they do inflation, where you can get like an 11% return this next year on them. It's kind of crazy. We have organized exchanges, New York Stock Exchange. Most of them now are electronic. So I know if you go down to downtown New York, the New York Stock Exchange is there. There's a really cool place you can get a picture where it has the Wall Street sign and the stock exchange. You want to get your picture there. I took a group with me down there, a group from my church. We went down there to get pictures. We get down there and like, why are we down here? Why are you wasting our time? It's like, it's the New York Stock Exchange. They didn't care. So I wasted all their time, but I think it's a pretty cool place to get a picture. And you want to get your picture next to the bull, right? In front of the S&P, if you can get the crowd away from it. But yeah, there's the New York Stock Exchange is still there. I'm not sure what goes on in that building because almost everything's electronic now, but it's sitting there. It's a big, impressive building now. But there's also over-the-counter markets, very sophisticated buyers, very sophisticated lenders and borrowers. They get together and they directly deal with each other. You have stock markets, you have bond markets. Private placement, that's on the bond market side where they do it without a lot of regulatory scrutiny because they know you're dealing with very sophisticated people. On the bond market, you can have junior debt, which is going to be no collateral, high interest rates. Secure debt. Secure debt is a firm like Delta Airlines, when they're essentially bankrupt, they were still able to borrow money at low interest rates because they had all these airplanes as collateral. And people had no trouble loaning Delta money, even though they were bankrupt, because they had airlines, they had airplanes back there. Commercial paper, that's when real high quality companies borrow short term. They just need money for 3 months to do commercial paper. It's called the CP market. Lines of credit is where you set up the ability to borrow from banks. You set up a line of credit. You could do that individually, right? Banks provide lines of credit to individuals. And you set it up and say, hey, you have a line of credit for 10,000. That's kind of what your credit card is, isn't it? Really, that's a line of credit. You can use it up to the limit. Leases, you can do leases where you essentially, instead of buying something, you lease it and you kind of rent it. There's operating leases, capital leases. I think accounting is getting away from that distinction and making everything a capital lease, but yeah, you can lease. These are all different ways to borrow money or issue stock. So if you're a finance person, you're probably going to become an expert in one of these areas. And just learn it backwards and forwards. There's a lot of careers in these different areas. So those are the different markets. You're going to spend your time in the secondary market. And so I'm begging you, get an account and start doing it. Start experimenting, do some things. Most of y'all are going to be investing where? Your first big investment will be your 401k plan. So what is that? It's like a mutual fund that your company sets up for you. There's a good chance your company's ripping you off. So come call me when you get your first job and I'll let you know if they're ripping you off. There are probably 50% of the firms out there have a 401k plan that rips their employees off. It gets really, really mad. But you can also set up your own accounts. So you saw there with Ameritrade, you can set up a Roth IRA. You can trade stocks and bonds and options in your Roth IRA. It never gets taxed, so any gains you have in there is tax-free. So you know it's not a bad way to set that up. So you know, get started, do something. If for the minimum reason that you have something to talk about in an interview. Okay, remember the number one thing employers are looking for is curiosity. It sounds really bad. You're a finance major, but you've never traded a stock. That just sounds, yeah, I'm a finance major, but I don't find it all that interesting. That's not good in an interview. They want you just bouncing off the walls, excited about finance when you get into the job. All right, and that's one way to prove it is to have an account. Okay, so given all of that, we're going to get into this question: is there an optimal capital structure? Is there something we can do between debt and equity that we can maximize the value of this firm? And the maximum value of the firm is wherever the cost of capital is at its minimum. All right. So is there a solution? And these two Nobel Prize winning people, I think they both have passed away. up there? Mira Modigliani. Let me find Wikipedia. I do like Wikipedia better than Investopedia. I just can't spell Wikipedia. So very, very famous, Franklin Modigliani. He passed away in 2003. Merton Miller, maybe the more famous one of the two. He passed away in 2000. Very, very, very famous. So much so that they won the Nobel Prize for it. So what's so important about what they said? Now, my concern is we're going to go through this, and at the end of it, you're going to say, oh, is that all there is? Right? So this was earth-shattering. Some stuff that's earth-shattering in finance, you might say, well, that seems kind of obvious after the fact. But some of the stuff they discovered is kind of obvious after the fact, but someone had to figure out the obvious so we would understand it. And so they asked the question, does it matter if a firm has 40% debt, 60% debt, 80% debt? And their surprising first answer was, it makes no difference, it's not important. That was their first answer. Their second answer is, it makes a lot of difference. And both of those answers were true. So which is it? Does it make a lot of difference or not make any difference? And they say, in a world without taxes, and without bankruptcies, it makes no difference. How many of y'all live in that world? You live in a world with no taxes and no bankruptcies? You do, don't. So maybe as a college student, you do. They say in that world, it doesn't matter. But in a world where there's taxes and there's bankruptcies, it makes a big difference. All right, so that's what we got to figure out. So we'll start here. So what are we doing on Thursday? Y'all promising you're not going to disappoint me on Thursday. You're going to come prepared. I got a text from the vertical gardens people, and I'm really bad at text, so I don't think I ever got back to y'all. Are y'all figuring out your answer? Is that your team, Patrick? Or? And if y'all want to come early Thursday and meet with me to talk about it, we can do that.